Welcome everyone to the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish, and we are dropping the hammer on cash flow problems so you can build things that matter. And today's topic is a tax topic. I think it's kind of an important one to understand. So we're going to be talking about the difference between failure to file a tax return versus failure to file your tax due. So there's a little bit of a nuance there. It's not all the same thing. We do have we come up to different points with clients where, again, they think, and we're going to talk a little bit about like the difference, but they won't file because they can't afford to pay or, so on and so on. So again, let's talk a little bit about the differences, kind of the things that you want to avoid. And we'll go from there. So filing a tax return is literally filing the return, right? So we're coming up on another deadline, and getting the return actually filed is one step, and you're getting, and I don't want to say penalized because that's not necessarily what I want to say, but it's two steps. Filing the return is step one. Paying the balance due, if you have a balance due, is step two. So basically, you need to do both steps. They're not all lumped in together. They're two steps. So filing the return is literally submitting it. And again, nowadays it all goes in electronically, right? In the olden days, and I'm old enough to know, back in the day, we actually physically mailed them. So that's showing a little bit of age there. But yes, back in the day, we actually mailed them. And then the second step after you file that return is you pay it. Now, a lot of you are paying electronically, so it seems like it's all the same function, but it really is. It's two separate functions: filing the return and actually paying your balance due. That's going to be two very different things. Some people still write checks, but now a lot more clients are paying electronically, actually paying electronically with the return actually being filed. And so there's a misconception that I'm filing my return, filing and paying is the same thing. It is not. It's two different things. So what happens when you don't file? You're going to incur penalties and interest for not filing the return, and that is going to be step one. There's penalty structures for each one of these, and much of the penalty structure is going to be based on the effective interest rates at this moment in time. So right now, with interest rates up there, in the 5, 6, 7, 8% range, your penalties and interest calculations are going to be larger than, say, they were 5 or 8 years ago, because it's not entirely the entire structure, but there's a portion of the penalty structure that's based on the actual federal income tax, federal interest rates. I'm confusing those two. But there are, again, like anything else, failing to file is a really big deal. Failing to file is one of the things where, say you have a refund, if you don't file after 3 years, you lose that refund, right? So it can actually not be, it could penalize you in the sense that maybe if you actually had money coming back to you, you lose it. The other thing is that sometimes over periods, you could potentially get picked for audit because they're actually not getting returns for you, right? So they're going to go back to an older period. Or one of the really, one of the things that can be even more of a challenge is, over prolonged periods of not filing, you could actually, file, you could be subject to, criminal charges because you're not filing your tax return. So again, the first thing is actually physically filing that tax return, right? You need to get that tax return in. And if you don't file the tax return, the time and the statute of limitations continues to run on that thing. And so much of the rules related to audit and so on are based on that statute of limitations. So basically, you are starting the clock when you file the return. And if you don't file the return, the clock keeps running. So that's where, again, the service, or not just the Internal Revenue Service, but even your state agencies could come back after you. So there are some issues that that you need to think about when you're deciding, like, well, I'm not going to file at all. Now the statute of limitations is running because you haven't paid. You're incurring penalties and interest because, I'm sorry, because you haven't filed. You're incurring penalties and interest because you haven't filed. So your statute's running, penalties and interest are occurring. And now, oh, okay, you haven't paid the tax. Most of the time, the clients of ours who haven't filed their tax return are going to owe because they're thinking, well, I'm not going to file the tax return because I owe. And if they don't know that I owe, then I'll be safe. Unfortunately, that's typically not the way that it works. In some cases, too, you have to think about if there are documents or income related documents that have been submitted to the tax authorities. So, for example, if they're 1099 sitting out there with your name and your social on them, et cetera, the service does basically comes back and says, oh, there's a bunch of 1099s in this person's name. They didn't file a tax return. We take the 1099s, we run a calc on it. We send you a love letter that says, hey, you owe us X dollars. So again, you're not completely getting away from it. It's just your statute of limitations is still running on it. You're still incurring penalties and interest for not filing. Now they've given you an assessment of what they think your tax is, and that may in fact not be your tax. So you're constantly spinning around by not filing. So worst case, file. Start your statute of limitations and ensure that you're not incurring penalties and interest for not filing. So what's the next thing? We don't pay. We don't pay ends up being a completely separate penalty and interest structure. So you've incurred penalties and interest for not filing. That's one set. You're racking those up by the day. And now you owe and you're racking up penalty and interest for not paying. So again, the penalty structure is going to be a little different. It's the up to a max of 25%, but again, it's all structured around the federal applicable interest rate. So again, with interest rates high, you're paying more and more and more, but you're accruing interest on those penalties by the day. And again, by not paying them, you're not getting away with it. You're just prolonging the larger number that will show up. And I've seen it sadly far too often. Clients who maybe only owed a couple $1,000, $4,000, $5,000, $6,000 from not paying, they have now turned that $4,000 or $5,000 balance due into maybe $10,000 or $12,000 because they didn't pay it. So what are your options? There are, again, you can pay full. Sometimes clients pay in full on credit cards. I don't think that's a great idea because the interest rates on your cards are going to be through the roof, but you're just moving your debt from from the federal government over to the credit card company. Not a great option, but some people do it. There are installment agreements. Many of our clients are on installment agreements on an annual basis. So we file their tax return. We request an installment agreement for the balance due on that return. It's split up, however the client decides is the best way for them to pay it back up to the max of 72 months. For a client who historically will have a balance due on an annual basis, we don't like to go out 72 months because sadly what happens, they get another year comes, another year closes, and they've got another year balance due. And then the balance due is just is compiling and compiling. And there's also offers and compromise. That's more challenging. That's where you really have to show that you have significant issues paying them, and you have to present financial information to them to show that you actually can't pay. It's an elaborate process. It can get quite expensive if that's the route that you're going. In most cases, it's probably cheaper to pay your actual balance due than it is to go the route of offer and compromise, because now you're working with someone to do that and you're paying someone for that service. The installment agreement is like anything else. You're continuing to rack up penalties and interest on that balance due while you are paying it. So essentially, it's a loan with some extensive penalties and interest on top of it. So while it is an option, it can get quite expensive. So once you're done paying your installment agreement, you could have incurred significant amount of penalties and interest over and above your actual initial liability. So it gets very, very expensive. But again, if you don't have the capacity to actually pay your balance due, it is a good option. Again, one thing to consider when you are going that route is if you do have a liability, and let's just use this last tax year, and we're getting close to closing out this current tax year, you do the next year's tax return, you have another balance due, you need an installment agreement. The initial installment agreement that you had becomes null and void. You have to apply for a brand new agreement. You have to aggregate all of your balances due into the new agreement and then get into a new agreement with the service. Again, it is an option. The longer you drag out that repayment option, the more penalties and interest that you're paying. Again, the more expensive that it gets. So the worst penalties are the failure to file, right? Not paying is more expensive than, I'm sorry, not filing is more expensive. They're so close. The not filing is more expensive than filing the return and not paying your tax due. So thinking that you're going to get away by not actually filing could ultimately cost you far more money. Because when they do finally catch up with you, and they will, whether it be the federal government or your state agencies or both, or all of the above, and if maybe you're paying on a county level as well in some of the states. If that number is going to be quite significant. And when they catch up with you, now you've incurred penalties for that whole period that you haven't filed. And now you're also incurring penalties and interest for not paying it for that period. So while I don't recommend either, I do recommend you at the least file, and that's any return across the board. We're not just talking income tax. I've seen in the past clients get hinked up on sales tax where they don't file their sales tax at all and they can't pay it. And so this is all of your filings. This isn't just that income tax return at year end. This is all of your filings. It's more expensive to not file than it is to file and not pay. Again, both are not wonderful, but again, you need to file. It'll at least be, and I'll use this very in quotes, cheaper. And even though it won't. Like anything else, you want to make sure, when you want to make sure you're very aware of what all the deadlines are. Not knowing when the deadlines are coming up is a problem for not just income tax purpose, but also, again, any of the other sales tax, payroll tax, any of those kinds of things. It is quite expensive on all, especially when you get into payroll and sales tax, which are considered trustee taxes. Those dollars were never your dollars. So the penalties and interest or the failure to file on those are actually far more significant than an income tax failure to file. So again, I think probably the one thing that you should walk away from this is you need to at least file that return. Get that return in and get it filed so that you at least have something. Now, income tax, April 15 rolls around. You need to at the least file that extension. Now, you're supposed to pay your balance due with it at the time or what you expect your balance due. Again, there are penalties, there are issues that will arise. It will get very expensive as well, but you want to make sure you're mindful of extension dates and actual due dates so that you can in fact get something set up. So strategies to avoid is making sure you're aware of the dates and the deadlines. Set up a payment plan. Again, it is going to get expensive to repay it, but it is far easier to get into a payment plan, setting it up, paying it back religiously over a period than it is to run away from the service and run away from the letters and then run away from the levies on your bank accounts and all of those things that will happen. Everything the service does has timetables attached to it. So there are reasons why you get letters at 3 months, 6 months, 9 months, etc. There are all legal statutes surrounding all of those due dates. So they will come. So it's a lot easier to work with your local enrolled agent or your local CPA to support you and help you get in an installment agreement than it is to run away from the letters. And typically it will cost you more to run away from the letters in the long run, not only in penalties and interest, but also in ultimately having a tax professional support you in unwinding the mess that can be made. Get help. You know, you do need to see, I would recommend you get an enrolled agent who are specifically only work in the tax area, or a CPA to support you. Again, a CPA who does tax work. Not every CPA out there is engaged in tax. So not every CPA can support, well, they can, but would really be able to do it. So again, be mindful that these are tax CPAs as well as enrolled agents to help you understand what your obligations are, what the dates are, what the potential penalties and interest are. It gets very, very expensive when you don't know. And in most cases, you can't go back to the agencies and say, oh, well, we didn't know. That's not an excuse that'll work. So work with someone who understands the dates, the obligations, and help you navigate it. Again, it's a lot easier to find somebody to support you to navigate the structure than it is to try to run away from the structure, because it will definitely find you. If you haven't filed or you haven't paid, first thing you want to do, if you haven't filed, get that tax return in as soon as possible. Again, you want to stop the statute, you want to start the statute of limitations. You want to stop the penalties and interest for not filing. And then the next thing is, if you do have a balance due, work with someone to help you get into some sort of agreement with the agencies that you're working with. All of these agencies are open to negotiations on installment. Some have different structures. So the IRS is structured in terms of now you can do most of it online. Again, filing forms. Some of the states, if you have an obligation with a state, it's probably best for you to call and get into an installment agreement. Again, have somebody in your back pocket to support you with this. They can, again, understand kind of how to navigate around and help you at least minimize any additional obligations that you may have. So if you walk away from nothing, if you take nothing from here today, I would say make sure that you file your tax return, whatever it is, an income tax return, sales tax, payroll tax, all of those, get them filed. That is the most important, because not filing is the most expensive if you don't file. And if you have a balance due on those, work with someone, again, an enrolled agent, a CPA to support you so that you can work out some sort of installment agreement with any one of the agencies that you may have an obligation with. If any of you have any questions, please feel free to drop them in the chat. We check it regularly to see if anyone has any comments or any concerns that we can try to answer. As always, we look forward to seeing you here every Friday, and I will see you next week on the Construction CPA's Coffee Cafe. Have a great day.